you talk us through the gap that we're seeing when it comes to valuation of developed markets versus emerging markets?
Sure. Yeah. I mean, so as with all markets, emerging markets go through happy times and sad times. They go through these long periods where they cycle from optimism to pessimism, and they have been quite out of favor for several years now. They haven't been winning any popularity contests. They haven't been front of mind for many investors. So there's a fair amount of apathy about emerging markets, but that's often where the best opportunities arise. So currently, emerging markets are trading at around 13, 14 times earnings. That places them at a fairly big discount to developed markets, and roughly a 60% discount to the US, that's quite a big gap that you see there. It's about as wide as we've ever seen. The only other similar period would be during the Asian financial crisis of the late 1990s. So the last time things sort of looked like this, the iPhone hadn't even been invented yet. So the cycles can get pretty long. The difference though today is that there's nowhere near the same level of financial distress and broad-based economic crisis that was prevalent at that time, yet this gap remains today. And that looks like a pretty attractive, compelling opportunity to us.
So at previous points in history, I guess that late 90s Asian financial crisis period, but also maybe at other periods where it's got close to this level of divergence between developed markets and emerging markets, what comes next? What does history tell us?
So this might come as a bit of a surprise to your listeners and advisors and investors, but emerging markets have actually outperformed developed markets since that inception of the EM index back in 1988. But they have disappointed, they have lagged over the past 15 years, as we mentioned. So there's a bit of a semi-persistent myth that emerging markets always underperform developed markets. And that's probably part of the reason why many investors have decided to simply move on to other things and forget about emerging markets a little bit. But to your point, historically, investors who stepped in at this point last time enjoyed a decade or more of outsized returns from that point. So when the sentiment shifts, emerging markets can re-rate and bounce back pretty sharply from those depressed levels, and it could very well be one of those points where investors look back on and they then wish they had acted once these happy times arrive again. So that's the case for emerging markets. Perhaps just to caution against something like the US, I think it's useful to remember that starting valuations is one of the best predictors of future returns. So at these levels and at similar levels in the past, with where US valuations are, the prospective returns over the next decade has been pretty low and close to zero or even less than zero on a real basis. So starting valuations and prices do matter.